Good morning and welcome to the Temple Bar Investment Trust Investor Update. Throughout this recorded update, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you up to Fund Manager Nick Purvis. Good morning, to you, sir.
Good morning, and thank you everybody for taking the time out to join us today. Hopefully, we will obviously plenty of time for questions at the end, and hopefully we will get round to answering most of them. My name is Nick Purvis, and I'm one of two fund managers. The other being Ian Lance, and we've had the privilege of managing the Temple Bar Investment Trust for coming up 5 years now. We took over the management of the trust in October 2020, obviously 2020 being the COVID year. I think to start out by basically just giving a brief description of how we think about investing in companies, and I promise you this is the only slide which has got a lot of writing on it. We are very much what you would call value investors. And what I mean by that is that we invest the trust assets in the more lowly value companies within the stock market. And why do we invest the trust money in lowly value companies? We invest the trust money in lowly value companies because there is a great deal of empirical evidence that shows that lowly valued companies over the long term, not each and every time period, but over the long term, give you higher levels of total investment return. I suppose an obvious question is why should it be that lowly valued companies give you a higher level of investment return? Because bearing in mind, of course, that often companies are lowly valued, perhaps because they operate in challenging or difficult industries. The reason we think that value or lowly valued companies deliver high levels of investment return over time is because investors exhibit behavioral biases. They become overly optimistic about the prospects for companies that are seen to have attractive prospects, and they become overly pessimistic about the prospects for companies that operate in more challenged industries. And as that over optimism and over pessimism is corrected or recognized by the market, the stock market over time, that results in the outperformance of more lowly value stocks. They basically surpass what are relatively low expectations within the stock market. And you could put it very simply and say that our job as Temple Bar's fund managers is to extract that premium return that comes from lowly valued stocks within the stock market. This is the proof statement, if you like, and obviously a lot of numbers on the screen. And clearly won't go through them all, but this actually looks at the US stock market, and you can see each of the decades going back about 100 years along the top there. And if you look at the numbers at the very bottom, what it shows is the excess return in each of those decades on an annual basis from investing in lowly valued companies. And you can see that lowly valued stocks don't always offer excess returns and can actually go through quite long periods where they don't deliver excess returns. But in the main, they deliver very strong excess returns. And this is what I mean when I talk about the value premium, the premium return that you get from investing in lowly valued stocks. As I said earlier, our job is to extract that premium for the benefit of the trusts, for the trust shareholders. This is the return performance record, or the returns that the trust has generated since we've we started managing it in October 2020. Not all good periods in the stock market, as I showed on the previous slides, will be good periods for value investing. But actually, the last 5 years or so have been a good period for value investing. And that has helped us to extract a very significant excess return from the stock market over that 5-year period. And you can see that since inception at the end of October 2020, we have managed to generate a return which is roughly double the level of return on the stock market. Now, the stock market itself has been strong, because if you remember, if you go back 5 years ago, in 2020, we were still in the depths of the sort of COVID-induced stock market drawdown. And obviously, as we came out of that, and investors realized effectively that because of the success of the vaccines, the COVID vaccines, life would return to some sort of normality. As you might expect, the stock market itself did well over that 5-year period. And it's gratifying to be able to say that we have delivered a significant excess return over that already strong return from the stock market for the trust shareholders. Now, I'll just probably insert a little bit of caution here, and we would say that that sort of level of excess return is not one that we think you should expect over the very long term, because, as I've tried to describe, that was in the last 5 years have been a particularly beneficial period for value investing generally. But if you extend your time horizons even further, and what we're looking at here is actually a very long-term track record. This is actually the track record of our longest standing client. And believe it or not, we've actually been managing one particular client's money for coming up for 25 years now. And in that period, the £100 invested in the stock market, you can see bottom right there, would be worth £375 today. We've actually managed to turn the £100 into around £740. So, and if you that's obviously 25 years, that's a 25-year track record. That actually works out at about a 3% excess return per annum. And I suppose, obviously, there's been plenty of ups and downs during that period. And I'll keep repeating, value investing doesn't deliver excess return all of the time. But we think that this is just, there's no reason in our minds, given the continued behavioral biases that we see in the stock market today, why in the next 25 years, we shouldn't continue to deliver this sort of excess return over time. So, as we say, a disciplined application of a value approach. It won't always get there, it won't always deliver, but it should deliver over the long term. So bringing it back to today, so if we believe that you should invest in lowly valued companies because starting valuation ultimately is the best predictor of future return, where do we think the value is today? Well, most of you will probably know that the US stock market has been the popular market to invest in over the last few years, and US stocks generally have done extremely well. So this chart here is simply a measure, a ratio of returns from the US stock market versus global equities generally. And you can see that the US stock market has significantly outperformed over the last 10 years or so, driven very largely, of course, by the success of the large technology companies in the US. But of course, as the stock market does well, so valuations increase. And what that means is that returns for future investors should go down, should reduce, because the starting point is that much higher. And this chart here is a measure of the valuation that is attached to the US market today. Now, you might be asking yourself, we look at Temple Bar Investment Trust is predominantly invested in the UK, not entirely. It's around 70% invested in the UK. So why am I talking about the US market? The reason I'm talking about the US market is because, believe it or not, the US market makes up about 70 to 75% of the global index generally. So it's a key constituent of most people's portfolios. And the challenge today, of course, is because it has performed so well, the valuation attached to US equities today is extremely high in a historical context. This chart, it says non-financial market capitalization to gross value added. That's a fancy way of saying market capitalization, the value of the US market compared to the GDP, roughly, of the US economy. And you can see that that is sitting at a multi-decade high. And what that suggests, it doesn't tell you that US stocks are going to do badly in the next 3 or 6 months or even a year. What it tells you is that the market today is priced highly, and that investors today looking forward should expect to receive a much lower investment return than they have enjoyed in the past. Now, conversely, there are other markets in the world which have been, you could say, marginalized or left out over the last few years. Stock markets in Europe, a number of emerging markets, Japan, you would say Japan has been left out, but we would absolutely include the UK in that as well. Now, the UK obviously has had some well-publicized challenges, should we call them challenges? The Brexit vote in 2016, obviously, perhaps being the most obvious. And it's not surprising, therefore, perhaps, that sentiment surrounding the UK market has been relatively poor. Economic growth in the UK has been relatively weak. Obviously, we're not alone. There are a number of European countries where that has also been the case. But the upshot is that the stock market, the UK market, has been neglected, and that today the valuation attached to the UK market is now looking very low. And of course, what that means is that the market from today's starting point should be set up to give you some attractive investment returns going forward. The chart itself just simply looks at some valuation ratios, so price to earnings of the companies, price to book value, or price to asset value, if that's the way you want to think about it, and dividend yield, and compares the valuations of the UK market versus the global index more widely. And you can see the dotted line shows that in a normal environment, of course, this is a 50-year chart, in a normal environment, the UK market trades at around a 20% discount to the wider global market. And that's by virtue of the companies that make up the UK index. They're quite capital intensive. They tend to be lower growth. They should stand at a discount. You would expect that. But today, that discount is clocking in at over 40%. And you can see that discount is as great as it has been at any point in the last 50 years. So we would argue, again, if you believe, as we do, that starting valuation is the best predictor of future return, the starting point of today should set you up for some attractive investment returns in the UK market in the future. Now, of course, we don't invest the trust assets in the wider market. We try and cherry pick individual companies where we think the valuation is looking particularly low and where we think the prospects for the business are reasonable. And the areas where we find the real value today are communication services. So that would be media and telecoms. Consumer discretionary, that might be retailers and auto stocks. Energy, obviously, that's the oil and gas companies, And then financials, and financials, of course, is can be either banks or insurance companies or even asset managers. Those are the areas where we're seeing the value today. And I'll give you an example. I won't slavishly go through this slide. You'll be relieved to hear that. But Johnson Matthey is an example of the sort of business that we're looking for. Johnson Matthey, I don't know if some of you will be familiar with it. It's a company that makes catalysts, and that's catalysts that use industrial processes or auto catalysts. It's one of the largest auto catalyst manufacturers in the world. The company is not a bad business. It's got good market positions. Most of its business is obviously not done in the UK. So if you do have particular concerns about the UK economy, that's not something that will particularly necessarily impact this company. So it's a business with good technologies, and just for one reason or another has not lived up to its true profit potential. In profit terms, our analysis shows that the company should be doing much better, even if it simply just matches the profitability of its peers. And accordingly, we think that the share price is very lowly valued today compared to the company's long run profit potential. And of course, one of the advantages of buying lowly valued companies, and when we bought Johnson Matthey at the beginning of the year, the shares were trading on around 9 times earnings, 9 times the annual profits that come out of the business, and a dividend yield of around 6%. One of the advantages of buying into lowly valued companies is the scope for positive surprise is great. So when 3 weeks ago, the company announces that it is selling one part of its business, actually to Honeywell, the US industrial company, one part of its business which accounts for a quarter of the group's profits, roughly, but accounts for more than half the company's market valuation, you can understand why the share price went up, in this case, by 35% in one day. So, but just an example of the sort of thing we're looking for. A reasonable business, not a spectacular business, but a reasonable business with good market positions, perhaps with unrealized profit potential, which by virtue of neglect is being overlooked by the stock market. Those are the sorts of companies that we're looking for. One advantage of buying lowly valued companies is that you're probably going to get more than your fair share of takeover bids for companies in the portfolio, as other outside investors, and this could be other corporates, as was the case in Johnson Matthey, or it could be private equity trying to buy the business to make a strong financial return. Whoever the buyer, you're likely to get more than your fair share of bids, takeover bids. Now, the UK market as a whole, because it is lowly valued and because we as a country are pretty friendly to the idea or understanding of the idea of overseas takeover bids, the number of, we do see in the UK market a high number of takeover bids on an annual basis. So you can see that last year the number was around 45. In the portfolio, this is in calendar 2024, Temple Bar saw four of its holdings on the receiving end of bids in that 12-month period, and those 4 were Anglo American, Currys, Direct Line Group, the insurance company, and IDS, which is the old International Distribution Services, which is the old Royal Mail. Now, 2 of those bids have succeeded. So IDS or Royal Mail has now been taken over. Direct Line, that takeover bid hasn't yet completed, but it will complete in the next few months. Anglo American and Currys both actually got away, quite rightly in our views, because the bids continue to undervalue the companies. But the share prices don't go back to where they were prior to the bid. Normally, even when the bid has gone away, it can act as a catalyst. It can help other investors perhaps understand there really is unrealized value in these businesses. And of course, an obvious thing to say perhaps, but those 4 bids last year for companies in the portfolio were very additive to the trust's return in 2024. Another thing that the one needs to be aware of, when companies are lowly valued, which obviously, as I keep saying, the UK market is generally, and the companies in the portfolio even more, in the trust portfolio even more so. What it means is that share buybacks, where companies generate cash and use some of that cash to pay a dividend, but then use another portion of the cash to buy back or retire cheap equity, it is very, very value enhancing for shareholders that choose not to sell into the buyback. You need to think about that a bit. But if a company generates 10% of its market value in cash flow in a particular year, so it's on a free cash flow yield of 10, and that's a pretty typical number for a company in the portfolio. And the company says, right, I'm going to take 5 of that 10%, and I'm going to pay you a dividend with that. So obviously that's a dividend yield of 5%. And I'm going to take the other 5%, and I'm going to buy back 5% of my shares in issue. What that means, of course, is that every pound of profit generated next year by the business is worth 5% more to the remaining shareholders, because the number of shares in issue has declined by 5%. And so what that means is that earnings per share next year are up 5%. Now, if the business actually has a bit of underlying growth as well, so let's call it another 5%, then the investor has effectively a 15% total return, because the investor takes the 5% dividend yield, the 5% of earnings per share growth that comes from reducing the number of shares in issue, and the 5% that comes from the underlying earnings growth of the company, and you're all of a sudden looking at 15% investment return. So buybacks are a very, very powerful tool for lowly valued companies to realize and demonstrate value to their shareholders. And this chart shows a number of companies in the UK market that bought back over 1% of their stock in the last 12 months. You can see that number is clocking in at 40 to 50%. Now, of course, that's the market overall. For the trust, the number is higher. We think it's around 60% by number of the companies in the portfolio are buying back their stock today. And this also has been a very powerful driver of the trust's return over the last couple of years. You take a company like, let's give you an example, NatWest Bank. NatWest Bank, I believe, roughly, the shares in issue in NatWest Bank today are down around a third from where they were 3 to 4 years ago, as the company has been profitable over that period of time, as you probably know, but it's been very, very disciplined about the way that it uses its capital. So it's been using its capital, the cash flows generated, to continually buy back cheap stock. So it's reduced the number of shares in issue by about a third, and the arithmetic would tell you that every pound of profit generated by the company today is worth 50% more, roughly, than it was 3 to 4 years ago. So these are really, really powerful drivers of value. You can add the dividend yield that a stock market will give you to what we call the buyback yield. So that's for the market as a whole, the proportion of the market valuation, which is basically being bought back by the companies themselves. And you can add those two yields together to get a what you might call a total shareholder yield. And in the UK, you can see that's around 6% today, higher pretty much in every other market, and roughly double the level of yield that's available in the US market at around 3%. And remember, of course, going back to what we were talking about being just how popular the US market is today. Think of it another way. As an investor in equities, you get paid over time, you get paid by the stock market a premium return for taking on risk, for taking on accepting the volatility that comes from investing in equities. And over time, an equity investor can normally expect to receive around 8 to 9% per annum. That's including dividends. Probably, roughly half, probably 4% from your dividend, and let's say 4 to 5% from your earnings growth or dividend growth over time. Well, think of your 8 to 9%. Well, you're getting in the UK, you're getting around 6% of that, almost upfront in a way, by virtue of a shareholder return yield. So you're not asking much from the growth of the underlying portfolio stocks to get to that 8 or 9% annual return that you're looking for. What I hope has come across is that what we are looking for the trust portfolio is not, we're not looking for spectacular businesses, because spectacular businesses are normally priced as spectacular businesses. And as I said earlier, because of the behavioral biases we tend to see in the market, when companies are seen as spectacular and priced for perfection, normally the result is disappointment. And that disappointment can lead to very, very poor share price performance. So we try and keep out of trouble by investing in companies which are seen to be spectacular by the stock market. We look for unspectacular, decent, but relatively ordinary businesses, which have good finances, good balance sheets, and therefore they can withstand a recessionary period. And recessionary periods can always be around the corner. We never know what's around the corner. So you want unspectacular businesses which have on some level been ignored by the stock market and therefore stand on low valuations, which have good finances to protect you in difficult times, and where you've got management teams who are totally on board and are driving the business for shareholder value. And we use the example of Next PLC, actually the retailer, you'll all be familiar with that company, to show just how what you might call an unspectacular business can deliver spectacular investment returns over time. Now, we don't hold Next today. I think Next is a great business. We just think it's fairly valued. We actually hold Marks and Spencer in the portfolio. But the point I'm making is, if you look at the chart on the left there, you can see that over a 25-year period, Next grew its sales by 5 to 6% per annum. That is a little bit more than nominal GDP growth. 5 to 6% per annum. Its profit before tax went up by around 7% per annum. That's the bar in the middle, because there's a little bit of financial gearing in there. But it very, very systematically over that period bought back its stock. It used the excess cash flow that it generates to buy back its shares at good prices. So it just gradually reduced the number of shares in issue. And therefore, the earnings per share went up by more than the earnings, significantly more. Earnings per share grew by 12 to 13% per annum over that period. You had a 3% dividend yield, and all of a sudden you're looking at a 15% annual total return. Look at the chart on the right, and this excludes the dividends, by the way. It is amazing, the law of compounding. If you can start to clock in regularly high single digit or even low double digit returns simply on a capital basis, so ignoring the dividends, it's amazing what will happen to the share price. So the next share price went from around £5 in the year 2000 to well over £100 today. So really, a real proof statement that you can make some great returns without having to risk investing in what you might call spectacular businesses. And that's, of course, what we try to do for the trust. And this is the top 10 holdings of the trust. Again, you'll be relieved here. I'm certainly not going to go through them all, but we would cap, and of course, happy to take your. I suspect you might have some questions surrounding each of the individual companies, and there's certainly a good number of these companies have got their challenges. There's no doubt about it. No doubt about it. A couple of them have been in the headlines for you would argue, the wrong reasons, but actually, we think their franchises are reasonable ones, and that over time they can grow their profits, not necessarily each and every year. Look at the middle chart there. That's the price earnings ratio. The number of years you have to wait before your investment is paid back by the company's profits it is generating today. And you can see that the multiples are obviously low, and often in many cases they're below 10 times. So again, remember, you just flip the PE on its head and you get an earnings yield, and the earnings yield, obviously a PE of 10 is also an earnings yield of around 10. The portfolio overall, if you added up all the PEs and calculated the weighted average, it'd be standing on around 9 to 10 times today. So that would be an earnings yield of 10 to 11%. And then you can see the dividend yields that are available, often generous dividend yields that are available on the right there. And I suppose in summary, what I would say is that we believe, going back to the characteristics I was talking about earlier, so reasonable businesses, low valuations, cash generative, and management teams, good balance sheets, and management teams that get it, i.e., they are in the business of driving value for their shareholders by paying generous dividends and using cash flow to retire cheap stock. A collection of businesses such as that, we think, can continue to deliver the sorts of returns that you as Temple Bar shareholders are looking for over time. And that concludes the presentation. Happy to take any questions.
Nick, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated on the top right-hand corner of your screen. We have received questions both pre-submitted and throughout today's presentation, and I want to start off the Q&A session with a pre-submitted question here, which reads as follows. The trust has reached an all-time high share price in late May. Is the trust now priced for perfection? Are some of the underlying investments equally priced?
Good question. I think the measure of you're right. Obviously, the share price is at a record high. Obviously, as I said, it showed in that chart earlier, has bounced very strongly off the COVID lows. I think is it now priced for perfection? I think the impartial measure, the best impartial measure of that is the valuation that's accorded to the portfolio today. And as I said, the portfolio as a whole is on a weighted average PE of 9 to 10 times. And that continues to be a significant discount to the wider UK market. But, and remember, I was saying that the UK market itself looks good value compared to other overseas markets. If you looked at a PE of the global index, you took all the large companies out there and you did a weighted average PE, you'd come out around high teens, so probably 18 to 20 times PE. Well, as I say, the trust stands on a PE between 9 and 10. So we think the valuation today, according to the trust, is probably a little more than half the valuation attached to the global index. So on that basis, we would absolutely say that it is not priced for perfection.
That's great. Thank you very much, Nick. The next question here: how do you distinguish between genuine recovery opportunities and value traps in the low valuation environment?
That's always, that's the most difficult question, because as I hope will have come across in the presentation, we obviously company profits can be quite volatile from one year to the next. It could be that the company operates in a cyclical industry. It could be that the company itself has made mistakes and therefore its profits are depressed in a particular year. And so we think that valuing a company of 1 year's earnings or 1 year's profits can be misleading. So we try and value companies of what we think is their long run profit potential. We try and look at, let's say, 3 to 5 years. Now, of course, that begs the difficult question: when a company suffers an earnings downturn, how do we evaluate whether the challenges that have led to that downturn, are they temporary in nature, and therefore it's not unreasonable to expect a profit recovery in the future, or are they permanent because of a fundamental change in the nature of the industry in which the company operates? And that is really difficult. And of course, there's no magic answer to that. I suppose all I would say is that we try very hard. We don't simply buy stock. We absolutely don't simply buy stocks because they look lowly valued. It is. You'll be pleased to hear it is more complicated than that, and we do a lot of work to try and understand the dynamics of the business, the change within its industry, and try and understand whether a recent downturn in profits is likely to be temporary or permanent. And we say we try to stick to decent businesses, companies which, by virtue of their market positions, can grow their profits over time. But there's no guarantee, and we do absolutely, we make mistakes. Of course we do. When we buy a company, we're having to make a set of assumptions about the business, about the industry going forward, and those assumptions are subject to error. But I suppose fortunately, we operate in an industry where we don't have to get everything right. And I suppose all I would say is that if you go back, think about that 25-year track record, I think we've demonstrated over time that the judgment call is right more often than it's wrong. But it's a great question, and it's something that we think about very hard, and we do a lot of work to try and understand, as I say, whether something is a value trap or a potential recovery stock.
Thank you for that. The next question: if the last 5 years have been good for value investing, why might the next 5 years be good for value investing?
Yeah. Also, another good question. I think it's to do with again, the way I'll try and answer that one is it's not. And actually, we don't have the chart. Wasn't in this pack, but you can try and measure the value of value, if that makes sense. So you can try, and it's slightly artificial, but you can try and divide the stock market into what you might call value stocks. So companies that operate in slower growth industries, more mature businesses that operate in slower growth industries, and what you will call growth stocks. So these are normally younger companies operating in growth industries, where obviously the growth outlook for profits is that much greater. So you can try and divide the market into what you might call growth stocks and value stocks, and you can measure the relative valuation of those two buckets. Now, you would always expect growth companies should be more highly valued than low growth companies or value stocks. That makes perfect sense. It's trying to gauge the extent of that differential and whether that differential is at any point in time is looking too great or too narrow. And there are times where actually that you could argue that that growth is relatively underpriced, i.e. the premium that you're having to pay in the stock market for growth is actually relatively low. That probably was the case in, I reckon, 2010, just coming out of the financial crisis, there was a period where that was the case. Today, if you look at the relative valuations of growth versus value, the differential is still pretty wide. So again, just go back to what I was saying earlier about the valuation of the portfolio. So it's on a P of 9 to 10. Again, the wider market on a P of 18 to 20, so roughly half the market valuation. Obviously, the growth element of the market, the growth stocks, the subset of growth stocks of the market will be valued at more than the 18 to 20. So that valuation differential is still pretty wide. And as long as that valuation differential is wide, then I think that we could feel confident that value stocks, from today, everything's from today's starting point. From today's starting point, we think that value stocks can continue to do well.
Understood. I've got another question here. How do you balance the timing of profit taking from outperformers versus the risk of premature exits?
I think again, it's very, it's a good question. It's very difficult, is the answer. I think we are driven by valuation. Ultimately, valuation is our signal, and I think as I said, we value everything on our view of the long run or normal earnings potential of the business. And if you think that over time, a typical company, not every company, but a typical company should be valued, you would expect to be valued by the stock market at, let's say, 13 to 14 times its long run earnings potential. That would be what you might call a fair valuation. Well, we look to buy things on, well, if we're really lucky, 6 times their normalized earnings, more normally probably 8 times their normalized earnings. And so if you buy something on 8 times its normalized earnings, then of course, all other things being equal, you get a 50% upside if it re-rates to 12 times normalized earnings. And I think, so we wait for that re-rating. We also recognize there's a big margin of error in what we do. So we're not going to be selling a stock because it's on 12 times its normalized earnings, because it could well be that the assumptions that we made surrounding normalized earnings were wrong. So we go back and we check those assumptions. So we try to let things that doing well, we try to let them run. We try not to be too quick to take a profit. And we think that's a bit of a sin of value investors. You're constantly jumping out of what's done well and buying what's done badly. So we try not to be too quick to take a profit. But at the end of the day, it is a judgment call. But we recognise that there's big margin of errors, and so we try not to move unless the valuation case is a strong one.
That's great, thank you. Just switching gears slightly, got a question here. It looks like you've been increasing your holding in the Dutch financial services company NN Group.
Yeah.
Can you talk through the attractions of the NN Group, please?
Yeah, actually, we haven't increased it for a while, so I'm not sure where that came from. So NN Group, for those who don't know, is a Dutch insurance company. It's got various parts of the business, but predominantly it's Netherlands Life is the more than 50%, around 50% of the business is a Dutch life insurance company. It really comes down to valuation. You can see, so the share price has done well. I won't know the exact numbers. Share price today is around 55 euros. I think the in price for the trust probably around 35 euros. So the trust has made a very decent return. And look at it, even following the increase in the share price, the PE is 8 times, and the dividend yield is still 6.6%. So you can imagine when we were buying it, the PE would be closer to 6 times, because obviously the earnings would have gone up, and the dividend yield would have been well over 8%. I think it was even 9% at one point. So the valuation dynamics are very attractive. Dutch Life there's very little in the way of growth. It's a very mature market, but it is a very well-run, conservatively run business. It's got a solvency, for those who are interested, it's got a solvency ratio of around 200%. The assets that back the life insurance policies are conservatively invested. A lot of them invested in Dutch mortgages, where the Dutch government actually guarantee a portion of the mortgage book. So I suppose we would characterize it as a safe, low growth, well managed, lowly valued business with a strong balance sheet. So that combination of attributes is essentially what we're looking for.
Perfect. We have a couple of more questions to get through at the moment. So if you haven't submitted your question, please do so. The next question: when was the position in Johnson Matthey first initiated?
January, February, I don't know exactly. So share price today is between 17 and 18 pounds. We bought around between, I believe, around 12 to 13 pounds in January, February. Then, of course, Donald Trump got to work on the stock market, and that gave us the ability to buy some more, actually, around 11 pounds during the tariff sell-off in April. Definitely an element of definitely an element of luck here. We absolutely always believed in the long run undervaluation of the business, but where we got lucky was the timing, because we obviously had no way of knowing that they were going to sell one of their businesses to Honeywell for such a big price in such short order. So hopefully the investment decision was right. The timing, definitely, there was an element of luck involved there.
That's great. And as I said before, the final question we've got at the moment is really around the dividend. Can you explain more about the new dividend policy reflecting share buybacks?
Absolutely. No, again, I'm glad you asked that question. So there's been an increase. You go back to what I was saying earlier about how buying back, when companies can generate strong cash flows, and most companies out there at the moment, operating conditions at the moment are relatively good. So most companies out there are pretty cash generative at the moment. And when you're lowly valued and you're generating a lot of cash, obviously, as I said earlier, one of the ways you really drive value for shareholders is by buying back cheap stock. And I think that's been, an increasing number of UK companies have recognised this and have started to prioritise buybacks at the expense of dividends. And what that has effectively meant is, obviously, there's, and buybacks are obviously create value for the trust. They are a source of return for the trust shareholders. But when you're simply paying out a dividend yield, that element of the return is not being enjoyed in the short term by the trust shareholders. So the dividend yield in a portfolio, obviously it depends on the share price, but has been great. It's around, last year was just over 12p. This year, hopefully, it'll be able to be a bit more than that. The share price today is just above £3. So the income dividend yield is around 4% today. Now, but that gives no value to the shareholders in the short term from the value that is being created by the companies themselves buying back their stock and driving future dividend growth as a result by reducing the number of shares in issue. And the board, we reckon, very roughly, around 2% last year in 2024, around 2% of these, take the companies in the portfolio, around 2% of the value of those companies was retired by the companies themselves through share buybacks. And of course, as I said, none of that was being returned to shareholders. And so what the board wants to do was to recognize that there was value being created and return a portion of that. And so the new policy, and obviously it's not set in stone and it is subject to change, but the new policy, and of course it's always the board's discretion, we're the fund managers, obviously that's not our decision to take. But the board's view was that they wanted to return one of that 2% to shareholders in the form of an increased ordinary dividend. So very roughly, the dividend yield on the portfolio goes from 4% to 5%.
Nick, perfect. Well, I think we've run through all those questions, so thank you very much. You've been very generous with your time. Please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback, and all the management team can better understand your views and expectations. On behalf of the management team of Temple Bar Investment Trust PLC, we'd like to thank you for attending today's presentation, and good morning to you all.